Welcome to this week's live strategy session. Great to have you with me. Heaps to talk about this week with a rebound in the stock markets, new all-time highs in some of the commodities. So I think a really interesting show ahead. Also, any stock codes that you want me to have a look at, get them ready. We'll go through them at the end of the show, look at the technical structure, see what we could be thinking about those moving forward. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's jump straight into our first chart. And as always, we have the ASX 200 to start us off. And finally, we're having a better week for the ASX 200. For the first time in 4 weeks, the index is going to end the week. Well, it looks like at least the index is going to end the week in positive territory. And I think the question a lot of people are now asking is, was that a lasting low? Did the ASX 200 make a final low last Thursday, or is this just a temporary reprieve before we see another round of selling? I've got some fascinating data I want to show you. It's about what has happened in the past after previous fast corrections, just like that which we've seen. Now, I think it'll probably surprise you. It's not what a lot of people would expect. I'm also going to update you on the indicator that I showed you last week, which was helpful in identifying this latest bounce, and just look at what it suggests from here. I'll show you that in a moment. But let's start with this latest price action. Finally, we're seeing buyers come in and buy this dip. And this is something that's been absent the whole way down. Just look at the decline. We've had a 10.5% sell-off, and that's been with barely an update. Look at this all the way down, barely an update. There's been one or two, but not too much. It was pretty much one-way traffic on the way down. So this was very much an aggressive selling, an aggressive sell-off that cut through several layers of support without creating a bounce. So far, this rally we have, it's a shallow bounce. So there generally hasn't been a rush to buy stocks at these lower levels. Since Thursday's low, the ASX 200, it's only put on about 3.5%. In normal conditions, would say 3.5% is great. That's a good week. But after a quick 10.5% decline, I'd describe what we've seen so far as a lackluster rebound. So just to compare that to the rally we saw after the panic sell-off last August, you might remember this. We had a 3-day panic sell-off, and that took the market back about 8% in those 3 days. And then 5 days later, the market was up about nearly 4.5%. So this time around, we've got a larger fall, but a smaller bounce. Now, this isn't to say that more buying won't emerge and that prices can't keep moving higher into next week. But at this stage, there hasn't been enthusiastic buying of the dip. And also note that the ASX 200, it also now has these declining moving averages and prices below the moving averages. As always, I'm using the 50-day and the 100-day for the moving averages. I think we need to be on guard for the potential of a structural shift where instead of buying the dips, as we saw so often occurring last year, instead of buying the dips, I think we need to be on guard of a situation where we get that shift in structure and it's the rallies that start being sold. That hasn't happened yet. It's something to be on guard for. Let me go back to that indicator that we looked at last week. Now, I'm just going to pop that on. I'll go to my indicator list, and it is, there we go. So this one here, this indicator which I've just put on here, what this is showing us the percentage both below or above the 50-day moving average. It's showing the price, where the current price is compared to the 50-day moving average as a percentage. And this is what we you may remember us looking at last week. And so last week I used the All Ordinaries as the base index. This week I'm going to just use the ASX 200. I used the All Ordinaries last week because we looked back over 40 years worth of data. ASX 200 doesn't go back that far. So ASX 200 will suffice for today. If you want that larger look back, just jump back to last week's video. So a brief recap. Last week I spoke about the All Ords being 6%. 6% below the 50-day moving average. And when that happens, there's a tendency for the market to rebound. So let me just quickly show you. So I'm just going to compress this up a bit, and I'm going to find 6%. I'm going to run this marker across, and you can see you've got this tendency at 6% when the price gets 6% below the 50-day moving average. There's a tendency for prices to rebound. Yes, there can be some overshoots, but it's around that 6% mark that we get the rebounds. Again, last week's video goes through that in more detail. And once again, the index we're getting that rally. We're getting that rally from around that 6% level from the 50-day moving average. The concern I have is that the rebound is lacking momentum, as we're discussing before. So far, it's a pretty shallow sort of rebound. And when you get that, it does set up the potential for a retest of the low. So prices rally, they run out of puff, they stall, and they come back and retest the low. It's a common thing we see in markets during selling phases. I'll show you how this could play out. I use the word could because, of course, I don't know how it's going to play out. Now, let me just show you a couple of quick examples. Just going to go back in time a touch. So the first one is this period in here. So this was in 2018. Now, the concerns during this period, and again, I'm using periods where we've got either an all-time high or a significant high, and then there's a quick reversal. So you can see the market's gone from above the moving averages to quickly being below it. 2018, what was the issue? Well, the issue was concerns about a slowdown in China and of all things, tariff and trade wars. So these themes that we see, they're often not new themes, they're often recurring themes. And yet again, tariffs and trade wars are behind a sharp sell-off. So this is a similar setup to current day, not so much because of the issues, but because of the price action. And what we had a quick sell-off from a multi-year high, quick 10% sell-off. Prices fell to, you can see down here, they got to 6% below the 50-day moving average at this low point. And from there, we had a shallow rebound. You look at this rebound; it's not dissimilar to what we have at the moment. Followed by a retest of the low. Prices fell again, retested the low, actually fell a bit below the low. Again, we can see the 6% retested from the moving average perspective, and then we got a stronger rebound after that. And while the worst of the selling occurred over the first few weeks, so the worst selling occurred over the first few weeks, a lasting low took several months to form. I think that's an important thing to note. Lasting lows can take a bit of time to form. Show you one more quick example. I'm going to go back to this period here. There's the GFC, had a strong rally over a year, and then we went through a corrective phase, which you can see I've got circled. The issue back in this time, this was all around the European debt crisis. Now, let me just quickly put our 6% marker back on the chart. Now, so the situation here, it was from a high, the highest point since the GFC bottom and highest point in the recovery to date. There was a quick 12.8% decline. So over a few weeks, market fell 12.8%. The indicator you can see here, it overshoots that 6% level before rebounding. And of course, during that rebound, the market rebounds. But again, it's a lackluster rally and market stalls, and we get a retest of the low. Again, a new low's made, another breach below this 6% region. And again, it takes several months. For the low to stick and for the upward trend to start to resume. So let's bring this back to present day. Bringing it back to now, let me just get rid of that for now. I think we should be prepared for the possibility, and it is only a possibility, for the possibility of a retest of the lows. Now, this may not happen. No one knows what is going to happen, but I think going off the muted bounce we've had so far and how this setup has played out several times in the past, I think there's a good chance we do get another shakeout before a larger rally back to the moving averages. So how do you play this? I don't think this changes the game plan that we discussed last week. I think it's still a case of avoiding panicking and sticking to a good game plan. I've used this week's rally to sell a few stocks that hit their exit stops in the previous week during the decline, which were just difficult to get out of during the panic. So I've used this rebound to close out a couple of positions. I'm still long stocks generally, but I'm also holding more cash, and I'm also using those wide trailing stops to hopefully see off any further sell-off. Now, if we don't get a further sell-off, great. If the market keeps moving up, fantastic, because I'm still holding plenty of stocks with those wide trailing stops. But should we do get another shakeout, it's those wide stops which do help me stay in a lot of positions. On the buying front, I'm not in a hurry to do too much. There are a few resource stocks that I think look interesting, but I'm generally not in a hurry to buy. We're in a period where the focus, I think, is on defense. There'll be plenty of good setups to consider once all this dust settles and we start seeing the odds shift back towards the upside. And invariably, that's when price gets back above moving averages and stabilizes and the averages turn higher. That's when the odds starts to shift back in favor of actively buying. As I said last week, I think it's a case of just staying cautiously calm, sticking to your plan. Now, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It tells YouTube you're watching. YouTube shows other people. That helps me heaps when people get to see it because YouTube's showing them. So please do those things. Like and short comment. Now let's move over. Let's go over and check out the S&P 500. And this is quite a similar situation to the ASX 200 in that we've had this sharp 10.5% decline, and it's been followed by a rally that's not really, at least at this stage, not really getting a whole lot of traction. And you just look at this rally to date. It closed on Thursday only 2.8% off the low from the previous week. So this isn't exactly a sign of investors rushing in to snap up bargains. Rather, we still have a situation where investors are hesitant to buy the dip. And I think this increases the odds that we do potentially get that retest of the low. So just to stress, retest of the low doesn't mean a continuing 10.5% unraveling. It means often we get close to a low, we get a rebound, we get a retest that often shakes out the last of the people who are going to get shaken out, and then often there's a larger rebound. It plays out differently every time, but these are sort of patterns that we do often see. It's interesting to see what's been holding the market back over the last week, and it comes down to that group of Magnificent Seven. So this is an ETF, MAGS, which holds those Magnificent Seven stocks, which at the moment aren't so magnificent. And rather than really getting a rebound in this group of stocks, Rather, it's been a case that the downward momentum has simply paused. And you can just see it's just been tracking sideways over the last week and a half. One thing I do think we should be careful of, though, is not to get too negative in the near term after a big fall has already occurred, after a market cycled from being above the moving averages to being below. It's been a nasty fall. Getting too negative after that is often a mistake, because when prices do get stretched to an extreme below the 50-day moving average, often you do get that rebound. I think there could be, prior to the rebound, I think there could be another testing of these lows, but I also think that larger rally back towards the moving averages is coming, and a rally in this group of the seven biggest cap stocks, a rally in those, well, that's going to be a key to getting a stronger rebound in the S&P 500. So bringing this back to the S&P 500, I saw some fascinating stats through the week, which I thought would be interesting to have a look at now. It was a study on the fastest corrections from an all-time high to a 10% decline. And let me show you a slide. I've got a slide which has this data. So just quickly working through what this means. So we're going from an all-time high to a 10% correction. And you can see, you can follow the dates down. Here's the most recent. It took 16 days for the S&P 500 to cycle from an all-time high to a 10% correction. And that's the sixth fastest decline since S&P began back in 1950. Now, look at what happened after other big sell-offs. You can see, just looking at what happened in the first month. There's a first month after other big sell-offs. So after 1 month, from 6 of these declines, 4 were back above their lows. After 3 months, all of them were above their lows. And you can see the numbers beside there for 6 months and 12 months. You can pause this if you want to go through this in detail. Now, it's important to note that anything can happen. This time could be completely different. The GFC, you can see in the middle from around 2000. Actually, it's the dot-com period, the 2000s. You can see that continued to get worse over the year ahead. So there's never any guarantees that things are going to work out the same way. And sometimes data sets like this make things seem better than they actually were. So an example of that was the 12-month after the 2018 sharp decline. So you look across and you go, oh, look, in years later, the market was higher. But if you look on a chart of that 12 months, it was an ugly 12 months. So the data can make things look better than they actually were. So you've got to be careful with these things. But I think the takeaway is that panic sell-offs often lead to at least strong rebounds and, in many cases, new highs. And that's often after many months of consolidation. So bringing this back to the S&P 500 just to close this off, and a lot of technical damage, there's no doubt, a lot of technical damage has been done. I think this opens the possibility of and we spoke about this last week, the possibility of a multi-month period of messy price action where conditions just get harder and we get chop. We get markets which come back and they rally, and then maybe range-bound markets are always a possibility. So my focus just here and now, it's on protecting capital. For me, that means holding a bit more cash, knowing where my exits are on the stocks within my portfolio. But I don't want to go and get overly bearish after we've seen a big sell-off. There are still lots of ways this could play out, and they're not all bearish. So I want to see what the next meaningful rally looks like, whether it be from current levels or whether there's another excursion lower before potentially a meaningful rally. We want to see what that looks like. We want to see how the structure evolves if it changes and we start seeing rallies back to the averages being sold, or whether the sell cycle's disengaged with a strong rally back above. We just need to wait and see. There's no crystal ball here to say this is going to happen next week. No one knows. So it's a case of following a good structured plan, managing risk, keeping calm, and watching how this price action evolves. Now, we're going to jump over to the US small caps. We've got the Aussie small caps, the commodities, go through all your stock codes, all of that coming up in a moment. Of course, that wraps up the free section. So if you're not a Strategy Session member, there's a link below. You click that, you come in, you pay next to nothing for a whole lot of information, which you may not find too many other places. So, that helps manage your portfolio and helps make money, or in these situations, reduce the potential downside. Well, I think that's probably money well spent. So, all of that said, let's start with, while we're on the US, we'll start with the Russell.